How to build an intrinsic value stock screener. Have you ever wondered how to find stocks that are truly worth more than their current market price? Today, we will discuss how to build an intrinsic value stock screener. This tool can help you identify undervalued stocks, which is essential for making informed investment decisions. Let's break down the steps to create your own screener. First, you need to understand what intrinsic value means. It is the estimated true worth of a stock, calculated independently of its current market price. For options, intrinsic value is the difference between the stock price and the strike price for and money options. However, when screening stocks, we focus on the stock's fundamental value. Start by defining your valuation model. Choose a method to estimate intrinsic value. Common models include discounted cash flow, dividend discount models, or Benjamin Graham's formula. Each model uses different inputs, such as expected future cash flows, dividends, or earnings growth rates. Next, gather the necessary data. Collect historical and projected financial data for stocks. This includes earnings, cash flows, dividends, growth rates, and risk-free rates. You can find this information on financial websites, in company reports, or through stock screeners. Now set up your screening tool. You can use a spreadsheet like Google Sheets or Microsoft Excel or a stock screener platform. Input your chosen valuation formula. For example, in a spreadsheet, you can automate calculations by referencing cells for earnings, growth rates, and discount rates. To keep your screener current, automate data import. Import live or updated financial data using built-in functions. In Google Sheets, you can use the ImportXML or Google Finance functions to pull in stock prices and financial metrics. Once you have your data, calculate intrinsic value. Apply your selected model to each stock. For instance, in a discounted cash flow model, estimate future cash flows and discount them back to present value using a discount rate. For Benjamin Graham's formula, use earnings, growth rates, and bond yields. After calculating intrinsic value, compare it to the market price. For each stock, see if the calculated intrinsic value is higher than the current market price. Stocks trading below intrinsic value may be undervalued and worth considering for investment. It's also wise to apply a margin of safety. Subtract a margin of safety, which is a percentage buffer, from the intrinsic value. This accounts for estimation errors or market volatility and provides a more conservative fair price estimate. Next, visualize and filter your results. Use conditional formatting or filters to highlight stocks where the intrinsic value is significantly higher than the market price. This helps you quickly identify potential value opportunities. Finally, remember to update and refine your screener regularly. As new information becomes available or market conditions change, adjust your data and model accordingly. Building an intrinsic value stock screener involves selecting a valuation model, gathering data, setting up calculations, and regularly updating results. This approach is useful for both stock traders and options traders looking to identify mispriced assets. With this screener, you can make more informed investment decisions and potentially find great opportunities in the stock market.